So thank you all for taking the time to tune in here. We also had a Working Party 11 session again in person yesterday, which is good to bring people together. Now, I guess, virtually today, but we're seeing many of you also in person, including in the business advisory group. Thank you very much. And last week also at the BIAC session. So thanks for that. I think what I wanted to say, just a couple of words as opening, I guess one is, it is extremely important contribution that you're making and that you're participating here today. I'll say a couple of words sort of specifically of where we are and what we seek to achieve here. But as you will have seen, much of the contribution and the discussions here from the business community, the wider stakeholder community, and others, civil society, have helped us shape the pillar and the pillar that it now is. So that's first. I thank you. Thank you also to you, Alan, and to all others that have spent the time to point out where we need to make improvements, where things might not be working, and we're very grateful for that. I think on the pillar, as you know, that the pillar is being built. At our last count, we have over 40 countries that are now building the pillar around the world, I think. We have issued the rules, as you know, we've issued the commentary, we've issued guidance, and I think we have also, and this is, I think, the topic of today, I think focused on compliance implications. I think also with the guidance on transition relief, on penalties, I think not unimportant, so that we have that, but also on the CBC safe harbor, the transition safe harbor. And speaking to many businesses, we understand that at least for a number of businesses that we've spoken with, that takes out up to 90% of the countries in which they operate, where they, during the transition period now, do not have to make a full ETR calculation. That was, I think, important for us. We provided this transition relief. I want to thank, I think, Kai Dandrin here specifically, and also our Japanese friends of making this all possible. This wasn't an easy discussion, but I think we've landed it, we hope, in a good place. We'll hear from you. I think we're now turning our focus here, and this is today, of course, of trying to work on a sensible form of administration. We'll talk about the return, but the return is a piece of the wider compliance dimension, which is important. So we'll talk about this, and looking forward, certainly from the Secretariat's perspective, our intention is here to land in a sensible place where simplifications that we can make, and I talk about permanent simplifications that we can make without undermining the tax policy objective of the pillar, is certainly something that we should be doing. We have heard many of the business comments on the return, very critical, constructive, but critical, and that's the dialogue that we need. I'm sure we'll hear more about it. I think a point of clarification, perhaps also on the return, that one does need to distinguish between data points that may be necessary to calculate the top-up tax liability, and then the question of the return. And these are separate dimensions. I think we already discussed this at an earlier one, where countries also have different cultures. But I think it is very important for us that we all start from the same data points, and then there's a discussion of which data points are necessary. What jurisdictional dimension can you calculate? Do you need to start in every instance from a constituent entity basis? Are there other things that give confidence in the system and confidence to tax administrations, but are easier to implement? And many of the things we're looking forward to today's discussion, and then ongoing dialogue on those questions. Talking about simplifications going forward that we can embed in the return, but also sort of beyond there. Of course, we're also working on the QDMTT safe harbor. You know that. I think that's a very important dimension also to reduce complexity. We already have said that it requires it to be built on the same data points, but given that there is a Q, i.e. a qualification in the top-up tax, I think that gives another driver towards standardization, resulting in simplicity, hopefully, as well. So I think that looking forward, hopefully, and helpful through today, we can land in a good place that is simple enough for businesses to be able to comply, but does achieve the tax policy objective. So I think that's certainly our vision, and we recognize that we may not be there today. That's certainly what we take away from the comments. We understand that may not be the end place. It's a journey, but thank you for being on this journey. Then I think second, tax certainty, the second topic here today, very important for us. Not just, I think, as you know, inside Pillar 2, but it's a self-standing pillar, the pillar before the pillars, as we sometimes call them, whether we do ICAP and other things inside Pillar 2, Pillar 1, but also beyond the pillars and transfer pricing. We've revised our MAP statistics framework, so there's a big dimension in the tax certainty here. Tax certainty doesn't start with the resolution part. That's where ideally we don't get to if we get good prevention, which starts with the very important parts of having systemic reviews as countries legislate, making sure that the laws of countries are consistent, which is why we do the guidance, why we have the model rules, why we have the commentary, why we do a peer review, and why we will publish the results of this so that everybody knows which country has a good income inclusion rule, which country has a QDMTT, so you can operate the system and the tax administration rely and incorporate this in the rule. It's also important that we have a standard data point return and that we work off the same data. And certainly we then want to explore whether we can keep tax administrations together on this journey. If they start from the same data point, there is a certain logic to explore common compliance approaches as we look into this. And of course, this will also be influenced by the way of adoption. If you're largely subject to an income inclusion rule and you largely deal with one tax administration, it may be a different element as if you have a higher level of coordination. If we all have QDMTTs where otherwise there might be top-up tax, again, that's a systemic simplification, which will reduce the audit challenge. But I think we need to look at this holistically. There will, of course, be disagreements, there always are. And so we do need to also think about the resolution dimension now. And I think that's also part of the discussion today, whether that's a multilateral convention or whether that is maybe embedded in domestic laws, a very interesting dimension that we're taking forward on a reciprocal basis. And then finally, in my remaining minute here, just quickly, I think, it's also that we are thinking more broadly, and this is not just here today, not just in terms of how can we have the right level of compliance cost in light of the tax policy objective, but as you may have seen from the report that we also did for the German G7 presidency, there's also a question, if you think beyond the pillar, is there something in the environment surrounding the pillar that may no longer be necessary once the pillar comes in? And we also think that that's an important discussion. So those are my initial words. And I think with that, I hand it over to you, Alan.
Thank you very much, Achim. And before I go any further, thanks to you and to the Secretariat for arranging this consultation meeting, and indeed to everybody who's taken the time to participate in it. Good also to hear, Achim, from your comments there that progress continues to be made, and particularly progress on simplification and certainty, which are, I guess, our two keynotes from business at OECD, and good also to hear that indeed it's been the inputs from business that have helped to achieve some of that simplification. Of course, today we'll be looking at the consultation based on the consultation documents that we were provided with, rather than on any of these subsequent changes. But good indeed to hear that sort of simplification progress continues to be made, and that we have remaining opportunities to influence that. As you said, Achim, it looks like a foregone conclusion that Pillar 2 will be successfully implemented in many countries already, and with that number increasing on a day-to-day basis. Just as you are providing technical assistance and review, we in the business community will also be monitoring how those legislation get implemented in practice in many countries. And I think it's important for all of us to remember that we need to continue to do what we've been doing all along, which is learning as we go. And I think that learning is a cooperative effort, and we look forward to continuing to do that. But since the rules were launched in December 2021, most of our efforts, of course, have been on some of the technical issues that were identified with the design of the model rules. Now, given the phase that we're in, our focus is really shifting towards administration and compliance. And this is a really critical phase of the project for business at OECD members, and for the business community more generally. As you know, we continue to work closely with the Secretariat, in particular through our BAG process, and we will, of course, continue to do that in future, given that we see significant opportunities for ensuring a simple but effective implementation package as a whole. Excuse me. Last week, as you say, we met, our Business OECD-Tax Committee met in Paris, and the consistent feedback from our members was, I would say, serious concern that the potential level of compliance that was presented in the public consultation document on the Globe information return is excessive, and for many M&Es will not be administrable in practice. Those are the concerns. And our review of the public consultation responses suggested that we're not alone in this, that other industry bodies, other companies shared these concerns. I don't propose to go into all of the detailed feedback that we provided in the Business OECD submission, but I would just like to emphasize a couple of key points. First of all, on the Globe information return itself, we believe that limiting the volume of disclosures required is crucial to the success of Pillar 2. It should be sufficient for disclosures to be completed on a jurisdictional basis, for example, rather than a constituent entity by constituent entity basis, which is the possibility which is presented in the public consultation document. For us, it's a well-established principle that modern tax compliance for multinational enterprises and large businesses is typically completed by way of self-assessment. This is both efficient and effective, and of course in line with the direction of travel which is set out on the Form of Tax Administration's Tax Administration 3.0 roadmap. In that sense, the design of the global information return as presented in the public consultation document seems like a step backwards rather than forwards. And it's hard for us to see what the really clear reason for that is, or what the obvious benefit of moving away from that direction of travel, which is taking place more broadly in tax administration. And that's because internal processes of multinationals are designed to comply on that basis of risk assessment and self-assessment, in the expectation that risk-based approaches and reliance on the integrity of underlying tax control frameworks is the best way to ensure compliance for everybody. For this reason, some of the proposals on the Globe information return, such as the potential requirement for disclosure on constituent entity basis, will place unnecessary and often impossible compliance burdens on some companies. Some companies also express concern that disclosure of so much detail could give rise to data confidentiality issues, particularly if those data were to get into the public domain. While disclosure on a constituent entity basis may in theory be possible for some M&Es, for others it will present significant issues due to the nature of their accounting system and the time it takes to configure and reconfigure those accounting systems. So we strongly question whether any of the perceived benefits of constituent entity by constituent entity reporting outweighs the cost for M&Es, and also the burden on tax administrations having to manage all of those data received. Second point I'd like to make is on tax certainty, and we believe that increasing tax certainty wherever possible is critical to the enduring success of Pillar 2. As the rules enter into effect, our members foresee major challenges arising from administrative and dispute resolution perspective. The work that's undertaken in the months ahead could go a long way towards mitigating some of these risks. I'd like to just summarize a couple of the key dispute prevention mechanisms that we identified in our submissions. Firstly, simplified manageable compliance with appropriate segmentation and exchange of information. Consistent design, implementation, and application of the rules by jurisdictions. Thirdly, we would just emphasize the importance of the peer review process and the publication of lists of qualified IIRs, UTPRs, and QDMTTs in particular. As you mentioned, Achim, a real focus on the design of permanent safe harbors that reduce compliance burdens, and the critical importance, central importance of the QDMTT safe harbor. So good to hear that progress has been made there. Adherence by jurisdictions to the agreed rule order. We're filing an audit request made via Elite Tax Administration. And then finally, a continued program of administrative guidance to clarify problematic issues as they arise and to focus on administrative simplifications and in the spirit of learning as we go that I mentioned earlier. So most multinational enterprises are actively trying to prepare so that they can comply with the introduction of the Globe rules. We would urge all jurisdictions and the delegates to focus on making these new complex rules manageable for business. Practical compliance and consistent application of the rules will also be of benefit to tax administrations as they seek to administer the rules for the first time. It's in everyone's best interest that the introduction of the rules be as smooth as possible. I've no doubt we'll hear more detail on many of the points I've briefly raised here, and I very much look forward to discussion. Thank you again for organizing and look forward to it.
Thanks, Alan. Thanks for coming in here. And yes, I think there's many themes that we have, I guess, in common echoed here. I think also the importance to realize that some of the concerns that you see as businesses are also concerns of tax administration. The return that you do, they will have to take in systems challenges you might have. I think tax administrations also face. So that's, I think, a useful discussion and dimension as we move forward. And as we move forward, we're slightly late and we've eaten into Felicie's time by 4 minutes. She will not tolerate that. So without any further ado, I hand it over to you, Felicie.
Yes, thank you very much, Hakim. I think we need more certainty about the agenda here. And so people will, of course, understand that we needed this additional 4 minutes. So we have 2 sessions for today. We will start with tax certainty. I'll first give an overview of the submissions that we received in that area before I give the floor to the panelists. And before I do that, I wanted to thank really all the commenters that provided us with the submissions during this exercise. And even if you're not a panelist today, you can be sure that your voice has been heard. The team has worked really hard in summarizing and compiling also the comments we received, which were so we had like more than 80 submissions for each topic for tax certainty, but also for the Globe information return, which were for each topic a little bit more than 300 pages that we analyzed. And so most of the submissions that we received came from M&Es or law or accounting firms. We also had some submissions from business representative bodies and academics for tax certainty. Overall, the majority of comments came from European countries, with a few also from Asia and North America, and also a couple of worldwide organizations submitted some comments. So if I start with tax certainty, I think what we can see, and you know that we at the Secretariat really believe in the potential for international cooperation, but actually that's also what the submissions underline and really encourage us to continue to do by, especially on the topic of tax certainty, but it will also be true for the Globe information return. On tax certainty, the submissions call for, of course, providing more tax certainty, as much tax certainty as possible, as we are now introducing new rules into the domestic legislation of the jurisdictions. Basically, the tax certainty is necessary to ensure 3 things in accordance with the submissions we receive, which are consistent application of the rules, a coordinated application of the rules, but also a coordinated application of the rules themselves with the existing rules. In relation to the consistent application of the rules, there is support, of course, for continuing to issue administrative guidance to provide clarification and to resolve possible differences in interpretation or application among the implementing jurisdictions. The correct application of rule order we already spoke about, which is really to apply the rule order correctly and to have, if possible, a list of published qualified rules and of other items to provide more certainty to those stakeholders who need to apply the rules. Then if I turn to the 2 main themes that we usually have in relation to tax certainty, there is certainly a call for continuing to provide dispute prevention mechanisms. So beyond the recognition of the fact that what is already included in the Globe framework will prevent a lot of differences among the jurisdictions that will apply the rules. There is also a call for going beyond that and creating or enhancing some existing tools that could prevent some disputes or differences in interpretation among those jurisdictions. And beyond dispute prevention, I will turn to that in a minute, there is also a call for having effective dispute resolution mechanisms. In relation to dispute prevention mechanism, we will hear from a couple of panelists who will also explain what possible ideas and possible tools could be developed for purposes of the GLOBE rules. A number of submissions talked about developing an advanced certainty mechanism that could allow taxpayers to submit their computations or their methodologies, for instance, to the tax administration and have certainty about how this will be treated by the tax administration. And there are also other ideas around more cooperation among tax administration. Some submissions also note that there is a resource issue and potential constraints that may then not help, of course, for tax administrations or taxpayers, because if you need to devote too much resources to preventing disputes, maybe you can't you can really apply the rules yourself. So there is this resource constraint, and some submissions have also called for a transitional approach or a kind of a grace period during which if no certainty can be provided, the disputes could be resolved maybe quicker. And then for the dispute resolution mechanisms, and what we received in the submissions is that there is the scope of issues that should be subject to a potential dispute resolution mechanism should be as broad as possible, should go beyond the issues where there is double taxation, but should also cover the issues where there is over taxation. Dispute resolution should apply not only when there are two implementing jurisdictions that have taken different views, but also maybe between an implementing jurisdiction and a non-implementing jurisdiction to ensure a coordinated application of the rules themselves with other existing rules, but also beyond that between the disputes that could arise between MNEs and tax administration. So that's really a call for having tax certainty and dispute resolution mechanisms in all kinds of disputes that could arise. Then the stakeholders have emphasized that the mandatory and binding dispute resolution mechanism is really the preferred mechanism because it would be then the most efficient way of providing certainty about the fact that any difference could be resolved and that there would be no overtaxation for the business who is applying the rules. Then, as you know, we have outlined in the public consultation document a couple of options that the inclusive framework could look at for providing a dispute resolution mechanism. So there is a lot of support for developing a multilateral convention in that regard. There is also some commenters who noted that the MAC could be an effective tool, although it may lack the direct access that could be given to taxpayers, but could be used to coordinate tax audits among the jurisdictions that are applying the rules. And efficient submissions consider that actually coupled with possible domestic provisions, the MAC could be used maybe on a transitional basis. And then to finish on the possible options, we know that we already have the mutual agreement procedures and a significant number of submissions. I highlighted the fact that existing mutual agreement procedures would be should be enhanced in order to be used also for global purposes. Even if they can be used, there are some deficiencies there that should be fixed in accordance with the submissions we received. Then maybe without going too far here, the last idea that was submitted in or was suggested in the submissions was to have an independent resolution process like an OECD committee or an international tax court that could be in charge of resolving any disputes that could arise in relation to the application of the group rules. I don't want to go too long with that. You know that you all have access to all the submissions that are published on the OECD website. So with that, I think I will start with the panels. And the first, so we have 3 panels today on tax certainty. The first one will emphasize why is tax certainty important for the implementation and the application of the GLOBE rules. I think we've heard a little bit about that earlier today, but still we wanted to give the floor to 3 panelists who will illustrate that in more detail. Then we'll have a second panel that will focus on dispute prevention tools and how we can prevent differences or issues in the application of the rules. And the third panel will focus on dispute resolution mechanisms and how we can resolve potential differences or issues in as the rules are applied. So maybe with that, then I will start with the first panel and call Futoshi Miyazaki, who is assistant manager at Sojit's group and representing Kate and Ren today. Are you?
Thank you, Tracy. Yeah. First of all, I'd like to thank the OECD for providing the opportunity to be part of public consultation meeting today. My name is Futoshi Miyazaki. I work in the tax department of Sojit's Corporation. Today, it is my pleasure to share input on tax certainty on behalf of Keidanren, the Japan Business Federation. The global rules introduce new requirements such as IIR and UTPR, which are complex and not currently a part of the international tax framework. Even though we expect the overarching rules to be consistently implemented and administered by each jurisdiction, one of our biggest concerns is that there could be different interpretation of rules, which may lead to dispute and double taxation. At first, we understand that jurisdictions are currently in the process of introducing domestic legislation of IIR, UTPR, and QDMTT. We are concerned about when the rule will begin to apply. It may differ amongst jurisdictions. OECD has provided that the UTPR will be implemented 1 year following the IIR, and most jurisdictions expect to introduce the IIR from 2024, the UTPR in 2025. However, we have heard that a certain jurisdiction may implement the UTPR in 2024 together with the IIR. We would like to emphasize that international tax harmonization should be achieved by aligning the timing of application rules and also taking into account the differences in the fiscal years of M&A group entities. Secondly, we are concerned that different interpretation of rules will raise disputes. For example, when applying the split ownership rules, and ownership interests may be interpreted in a different way between a UP resident jurisdiction and a POP resident jurisdiction. In such case, each jurisdiction may disagree on the top-up tax amount to be allocated to the POPE. Other global rules may also be interpreted in a different way, such as the qualified refundable tax credit and push down of taxes relating to CFCs, because there are various types of tax credit and CFC regulations amongst jurisdictions. In addition, the scope of covered taxes may also be a point of disagreement, as there are also various types of taxes in each jurisdiction, and it may be difficult to conclude which taxes meet the definition of covered taxes. In order to prevent these disputes, it's important to ensure consistency in the interpretation of rules, not only for jurisdictions, but also for M&Es. So we would expect OECD to compile issues of rules and to publish agreed upon interpretations. Thirdly, the treatment of QDMTT may also raise additional dispute. When calculating an ETR for QDMTT, it can use financial statement prepared in accordance with accounting standards that are different from those applied to the consolidated financial statements used for global ETR computations. This may create differences in the top-up tax amounts computed under QDMTT and IIR. Furthermore, if a DMTT that is adopted in a low-tax jurisdiction is not treated as qualified, a QDMTT deduction may not be applied in calculating a top-up tax. This could result in double taxation. With this in mind, in order to enhance tax certainty, a QDMTT safe harbor should be introduced that permits to calculate top-up tax as 0 to the QDMTT jurisdiction. Finally, when it comes to a tax audit, it is assumed that each jurisdiction would contact CE to ask for additional information and clarification on GIR. If CEs must respond to inquiries for every jurisdiction, this will be a significantly administrative burden to MNEs. In the view of the top-down approach taken by global rules, and it is generally expected that the UPE will control all the things about global rules in its group. The UPE resident jurisdiction should centrally make inquiries to the UPE on behalf of other jurisdictions. This also helps to enhance tax certainty. Considering these concerns, until the global rules are stably implemented with a broad consensus, a robust dispute prevention and binding dispute resolution mechanism should be put in place. We will welcome further guidances to enhance tax certainty and look forward to contributing to the ongoing discussion. Thank you very much.
Thank you very much. I think that was a very good introduction to the panels for today, and of course the call for more predictability in for business when they are applying the rules. So thank you very much for this insight. Then I think we give the floor to Thomas Quatrevalet, who is head of tax at Air Liquide, representing ICC today. Who will focus on the need for correct application of the rule order.
Thank you, Felicie. Good morning, good afternoon, everyone. I will be speaking on behalf of the International Chamber of Commerce, which is a worldwide institution representing businesses across all the continents. I want to start by reminding us of this famous quote from Benjamin Franklin in a letter to a French scientist, where he said, "Only two things are certain in this world, death and taxes." So even though taxes are certain, what is even more important for MNE, and I think for tax authorities as well, is to make sure that there is certainty on the way those taxes are calculated first, but also on the way they are implemented. And with this respect, ICC members fully support the policy intent of Pillar 2, because they believe it will help stabilize the international tax framework. But to achieve this, they equally believe that a consistent and harmonized approach is key, as was promised, in fact, in the October 2021 statement of the inclusive framework. That is, in our view, the best way to avoid disputes between countries, but also disputes between a taxpayer and the country which implements the Pillar 2 rule. And with this respect, I think we all recognize that there are several significant challenges that are raised by Pillar 2. The first one is, as Felicie said, the ordering of the rules. We often talk about the income inclusion rule and the UTPR, which could act as a backstop if no country where the group is present implements the IRR. But the domestic top-up tax and the qualified domestic top-up tax is likely to be even more important, and in fact it's likely to be the future of Pillar 2, because as countries are announcing that they will implement Pillar 2, almost all of them are saying that they will also introduce a qualified domestic minimum top-up tax. So based on existing rules, this QD-NTT would need to go first, and then would need to be credited against either the IRR or the UTPR. So that would require a significant amount of coordination among the various countries involved. We understand that QDMTT safe harbor could be further designed by the inclusive framework and the OECD. So we would obviously welcome this kind of mechanism to avoid this credit situation that is currently in the rules. But also existing CFC regimes need to be factored into the Pillar 2 equation. Today, many countries already have provisions that allow to tax the income of a foreign affiliate in the hands of the shareholder of those affiliates, and we want those CFC taxes to be taken into account. So we now understand from the February guidance that was issued by the OECD and the inclusive framework that CFC taxes cannot be credited against the QDMTT, which is good because at least we know how it will work, but it means in turn that all the existing CFC regimes will need to take whatever QDMTT payment is made into account in order to determine the amount of tax to be paid under the CFC. So that also requires a lot of coordination and making sure that all the countries that have such kind of regimes will play the game in a fair manner. And it gets even more complicated because certain CFC regimes are looked at on an entity-by-entity basis, whereas the top-up tax computation is performed at country level. So we recognize the huge work that has been carried by the OECD and the inclusive framework so far on the guidance, but we think that much more work needs to be done in ensuring from the onset that all legislation will work as intended in terms of ordering and will not create any double taxation situation. I will add one last topic, which is related to the consistency of the QDMTT with global rules. As I said, QDMTT are likely to be the future of Pillar 2 because most of the countries will enact QDMTT. And I have to admit that the business community is very concerned by the February guidance that was issued by the inclusive framework with this respect, because we realize that significant deviations are allowed if they are more restrictive than the global rules. Also, a different accounting standard than the consolidated accounts of the UPE may be used, and the use of transitional safe harbor is recommended, but is not mandatory. ICC members, you urge the inclusive framework and the Secretariat to carry out further work on this point to ensure that QDMTT rules really mirror the global rules, including on the accounting norm and the safe harbors. If those QDMTT do not all incorporate the transitional safe harbors, it means that the transitional safe harbors will only be theoretical, because in fact, MNE will be confronted to a detailed calculation in each and every country where there is a QDMTT. So we think that we understand that further work will be carried out with this respect. We want to draw the attention of the OECD and inclusive framework that this work seems really critical to us. Otherwise, the promise of consistency and stabilization of the international tax framework may not be met. And we think in this situation, everyone would be losers, not only MNE, but also tax authorities, which would have to deal with multiple regimes all over the world, which wouldn't be perfectly consistent. That's all I wanted to say. And thank you again very much to the OECD and the inclusive framework for allowing this discussion today.
Thank you very much, Thomas, and thank you for your kind and encouraging words as well. That the work that we've been doing has also recognized as helping here as well. We definitely understand that the rule order is critical and needs to be respected, and we also hear you and others, and because others have also made the same point about the QDMTT and the need for consistency in that regard. I think you've heard also others say that the work that will be done in the space of the QDMTT safe harbor will also be an opportunity to expect more consistency from the QDMTT jurisdictions or for the QDMTT rules in general. So then with that, I will turn to our third panelist, Charlotte Kies, who is partner at Lyons & Louf. Charlotte, are you here?
I'm here. Thank you, Felicie. And of course, also thank you for the invitation to allow me to speak a little bit more about tax certainty. As my co-panelists already emphasized, there's a strong need for a consistent application of the GLOBE rules. A consistent application will provide for tax certainty and will prevent double taxation resulting from, for instance, competing top-up tax claims. However, ensuring such consistent application comes with challenges, and I will provide you some examples to make that a little bit more clear. First of all, starting with the implementation of the GLOBE rules. You need to recall that the OECD GLOBE rules are not binding. So while the inclusive framework jurisdictions have committed to implementing the GLOBE rules in line with the model rules, if they decide to implement, there's no enforcement mechanism to ensure a consistent implementation. And reality already shows that there is no single harmonized implementation taking place. For instance, seeking to improve compliance with EU law, European Union member states have adopted a GLOBE directive that deviates on some aspects from the GLOBE model rules. For example, according to the EU directive, top-up tax under the income inclusion rule may be levied on low tax subsidiaries situated in the same jurisdiction as the entity levying the top-up tax. Whereas under the OECD GLOBE model rules, the income inclusion rule is only levied on low tax foreign subsidiaries. And the US is not implementing an income inclusion rule, but currently maintains their GILTI regime as well as their newly introduced book minimum tax. And we, of course, welcome administrative guidance on the GILTI qualification and allocation for GLOBE purposes as released on February 2nd. However, questions continue to exist, and it remains to be seen to what extent that guidance will effectively be implemented in national law and also be applied in practice. Secondly, also different qualifications of foreign taxes can be expected. And as Thomas already indicated, it's very important to have a coordinated approach on QDMTT and CFC, but also especially with these taxes, there is a risk of inconsistent application. So looking at qualification of domestic minimum top-up taxes as a QDMTT, it's very important that there's a swift assessment in order to come to a secure mutual agreement and recognition on what taxes can be considered QDMTTs. Otherwise, this can again lead to competing tax claims between jurisdiction alleging it applies a QDMTT and the jurisdiction seeking to apply the IIR or the UTPR. And also with respect to CFC tax, and what is a CFC tax and how should it be allocated to the foreign subsidiaries, there needs to be further clarification. Again, administrative guidance released last month takes a first step, in particular in relation to the US GILTI regime, but other jurisdictions might also have taxes whose classification and allocation is still uncertain. Another difficulty in consistent application of the GLOBE rules will also be the application of the different sets of accounting rules. Many tax authorities will need to become familiar with foreign or international accounting norms that are typically not used to determine the tax base under domestic laws. So this may easily lead to misunderstandings and inconsistent application of rules, and also deviation to the accounting rules made for purposes of applying the GLOBE rules even make this more complex, of course. Looking at also the transition rules, we're of course currently already for some time, we are in the transition period. So M&Es and tax authorities need to be aware of what all these transition rules mean. Also here, there are still uncertainties. There's more and more guidance coming through the commentary, through the administrative guidance. But still, there need to be further clarifications. So for instance, transition rules with respect to losses available for carry forward. Under the main rule, losses are taken into account through deferred tax accounting. An important requirement in the context of the transition rules is that deferred tax assets and liabilities need to be reflected or disclosed in the financial statements of the relevant constituent entity. Further clarity to ensure a single approach in application of these transition rules to what reflected or disclosed exactly means would be very useful in order to to prevent contradictory views and in order to ensure a consistent application already during this transition period. And finally, of course, and there were already some examples given by my co-panelists, complexity of certain rules may also likely lead to inconsistent application without having further guidance in place. So take, for instance, transfer pricing adjustments and the rule disregarding certain intergroup financing arrangements. This is a very complex rules and raises questions on its application. It may trigger possibly some views of circularity in the reasoning because of definitions, including interrelation between definitions on high tax counterparty, low tax entity, and the definition of intergroup financing arrangements, but also interaction with available tax losses for carry forwards and determining whether a lender is a high tax counterparty or not. And in addition, this rule constitutes a deviation from the arm's length principle and is accordingly liable to trigger disparities and complexity. Depending on who the lender is, the top-up tax may need to be levied under GloBE rules on the borrower or the lender. So all in all, further administrative guidance will be very, very important in order to increase the consistent application. But considering that jurisdictions are already implementing these rules, while administrative guidance is still developing and crystallizing, this will remain to be a challenge at least for this first period. So I think this also brings us to some of the other subjects that will be very important in the end for tax certainty on dispute prevention and dispute resolution.
Thank you very much, Charlotte, and thank you for making the transition yourself. Thank you for this insight as well, and for the call for further administrative guidance in this area, recognizing that the administrative guidance is actually a powerful tool because all IF members then adopt the same interpretation for a given aspect of the rule at the same time, and the call for publishing these outcomes is well noted as well. Thank you very much, Charlotte. So then we can move to our second panel, where we will now turn to some thoughts that were made by some of our panelists on how we can prevent some differences in interpretation and application in those implementing jurisdictions. So with that, we will start with Carl Berlin, who is head of tax at Ørsted, who will speak about coordinated risk assessment and how this could work in the GloBE space. Carl, are you here?
I am, and thank you, Felicity, and indeed thank you, Charlotte, for that very nice transition. First of all, thank you to the OECD for inviting us to elaborate a bit on the comments we made on tax certainty and how issues or differences in application of the rules can be prevented. First of all, we recognize the benefit of authoritative interpretations on the GloBE rules from the inclusive framework, and we anticipate that there may be common issues where this kind of guidance will be very helpful and will help align and coordinate application of the GloBE rules. So we see referral of general issues to the inclusive framework and the accompanying guidance that will be produced from that as a very relevant tool that can further tax certainty. But as a means to solve specific interpretation issues and application of the rules when it comes to a particular set of facts and circumstances, we don't think that that will be an adequate measure, and we don't think it will offer certainty to M&Es that if they have a particular issue, it will be addressed adequately and in an expedient manner. So while we see the value of referral of issues to the inclusive framework when it comes to general interpretation and guidance on the rules, we don't think it'll work as a means to solve particular questions or uncertainties that an M&E has. And these issues, as was mentioned previously, may not only concern whether an M&E is required to pay top-up tax in more than one jurisdiction or not, but can also concern, for example, valuation of losses carried forward, where the GloBE loss election has been made, or disputes on the applicability of safe harbor regimes, or disputes on compliance with filing requirements and where penalties potentially may apply. For solving these kind of issues, we believe that it would be helpful to develop a bespoke coordinated program similar to the ICAP, and that would yield better results. Such a program could allow for involvement of numerous tax authorities to help settle in advance any questions or interpretations that has implications for multiple jurisdictions. In the context of fast-moving business industries, and I think that's a general issue, taxation may have a significant impact on investment decisions. The ability to quickly and decisively gain certainty on the outcome under the global rules would be very important. And in order for such a mechanism that we have proposed to be truly efficient, it needs to provide for a fixed expedient timelines for any such rulings, and these rulings should remain valid and binding for the authorities in a reasonable amount of time after having been issued. And looking at today, I mean, the possibility in most jurisdictions to obtain either unilateral or bilateral APAs and the tax certainty that comes from that is really beneficial. But a significant drawback of most APA regimes is the often very long lead times associated with obtaining the agreement. It can take multiple years. So we think it would be important to build in a requirement to have a binding outcome to be reached within a specified time frame, for example, 6 months. That would significantly increase the value of such a mechanism and make it really viable for M&Es as a means to prevent disputes, and also put some pressure on authorities to coordinate the risk assessment. Finally, I'd just like to highlight the need for such a mechanism to provide for a right for the M&E to obtain a ruling, provided, of course, that the M&E supplies the required and necessary information. For a multinational, there would be little point in spending resources and disclosing potentially very sensitive facts if there is no guarantee of that effort actually resulting in an increased tax certainty. And as such, in order to be effective, the rules must offer the M&E certainty of engaging in the process, that will ultimately lead to the desired certainty, whatever it may be, and also associated authoritative interpretation of the rules. So thank you very much for allowing us to present these views.
Thank you, Carol. Thank you very much. That was really clear. And yes, I understand, and and thanks for sharing these thoughts with us about this coordinated risk assessment program that could be elaborated or explored. And we understand definitely that ICAP has been considered successful by the M&Es that are using it and by the tax administration. So whether it's ICAP or another form of corporation, we understand that there are some benefits in ensuring or providing scope for cooperation and coordination among tax administrations before even an audit can be launched. So with that, then we turn to another idea that will be presented today by Will Morris, who is Chair Emeritus at Business at the OECD. Will, I don't know if you're online.
I'm definitely online. Thank you, Felicity. And thanks, John and Akim and others for inviting us. So I'm speaking today on behalf of the Pillar 2 BAG, the Business Advisory Group, and bringing forward an idea which is a collective one. Not, I can claim very little credit for it, but I'm delighted to be here. I just want to emphasize in a minute or two what Alan said at the beginning, which is that the BAG fully understands and completely accepts that Pillar 2 is coming. This is a reality. And therefore, our only aim at this point is to try to make it work better. Better for countries, for tax administrations, but certainly obviously also better for taxpayers. And in relation to that, there are three quick elements that I'll mention. The first that actually Felicity referred to right at the beginning, which is that we would ask that consideration is given as the rules come in per the schedule in 2024 and 2025, that there be serious thought given by countries, by member states, to essentially a phased lead-in, what some countries call a soft landing, in order to allow us to test how some of these rules are going to work. Obviously, people complying with them, but nevertheless, a certain tolerance about that. Point number two, which will be dealt with later, is again the cutting of complexity in this wherever possible down to what will satisfy, again, the needs of countries but in the least complex way. And obviously, one of the things that people are going to be talking about is, wherever possible, cutting down on constituent entity by constituent entity reporting. Let me say to the delegates who are listening today, we understand this is on us to prove to you that the jurisdictional level data is reliable, is trustworthy, and will fulfill the purposes of Pillar 2. And we will be working in a number of ways on that in the coming days, and we'll hope to be able to convince you of that. Point number 3, which is actually what I was asked to talk about, is tax certainty, and in particular advanced certainty. And again, I would just echo what Félicie has said, what Achim said about the broader tax certainty tools which are already out there, both ICAP, but also a remarkably good paper which came out last year under the German G7 presidency, which I think Achim referred to, and which I hope we can work on in parallel with that. But as Achim also said, the best way to deal with disputes is to prevent them from happening in the first place. And the idea that that we put forward in our BIAC response to the consultation is for advanced certainty. It's inevitable that disputes are going to arise, but to the extent that we can prevent them from arising, then we'll all be better off. And we think that a form of advanced certainty could provide significant benefits, both for taxpayers and for tax authorities. But it all interlinks. Anyway, advanced certainty, at least as we envisage it, would allow taxpayers and tax authorities to agree key aspects of the globe computations and potential simplifications at the beginning, where it's possible to advance tax certainty in some jurisdictions via APAs. These aren't universally available, and the scope of APAs may not be broad enough to cover Pillar 2. And therefore, the development of a common standard for a globe APA-like mechanism, if you will, advanced certainty, would be great. So we think there are 2 possible ways in which taxpayers might be able to obtain certainty within a predefined timescale directly from tax authorities. Firstly, in relation to a qualified income inclusion rule or a qualified domestic top-up tax, directly from the primary tax authority, and perhaps in the case of the UTPR slightly differently, maybe from an ad hoc panel of UTPR jurisdictions, which could include representatives from a certain number of countries, but which, nevertheless, in both of these forms of advanced certainty, would be binding on all other jurisdictions in order to prevent double taxation right from the outset. Now, this is very similar to Pillar 1, to be sure, and therefore we think that the advanced certainty, the APA-like mechanism, could leverage some of the features of the mechanisms being proposed by Pillar 1 also, and we think that's worth consideration. We think advanced certainty could be particularly useful in areas where an element of judgment is required, which has an impact on a number of jurisdictions. For example, this is only a for example, but for example, the allocation of tangible assets and employee numbers or payroll costs can obviously have an impact on the calculation of both the UTPR and the substance-based income exclusion. Other examples could possibly be where the UPE jurisdiction doesn't apply a qualified IIR, and there are multiple intermediate parent entities in the corporate structure, as this mechanism could allow a multinational enterprise to clarify which entities are covered by an IIR with relevant jurisdictions involved. Again, so much better to sort this out in advance than to have an argument about it afterwards. We think that the advanced certainty mechanism could be used also to address differences between the globe rules and the domestic treatment of an item of income or tax expense. For example, an M&E might have a permanent establishment for the purposes of the globe rules, which is actually treated differently under the domestic law of the head office or the permanent establishment jurisdiction. Using an advanced certainty process, the M&E could ask the affected jurisdictions to agree a proposed allocation of income under 3.4 of the model rules and an allocation of covered taxes under 4.3. And this process could equally be used for other allocations to hybrid CFC and tax transparent entities. Again, the goal of addressing these types of issues up front should be to reduce the disputes arising at a later stage when they become much harder to solve. Where agreement can't be reached on an issue within a predefined timescale, we do believe that the relevant issue should be able to be referred to the inclusive framework to be reviewed and clarified by way of further administrative guidance. Anyway, Thank you very much for the time. Thank you for the invitation to comment, and we look forward to continuing to work with you on this.
Thank you very much, Will, and thank you for explaining those ideas as well to everyone. And I think these are also interesting ideas, and we're also a bit late on the agenda, but early on the advanced certainty topic, and there may definitely be a need for these kind of processes as well, and especially when, as you said, the transitional safe harbors would expire, or when the UTPR would become applicable. So with that, then we'll turn to the third panelist for this second panel. And we have Alison Lubb, who is partner at Deloitte, who is with us today.
Thank you very much, Felicia, and thank you for the opportunity to share some thoughts. Good afternoon, everybody. So I agree with the comments made by previous panelists, and in particular, I am going to focus on the desire for consistency of approach and ways that it may be possible for the OECD inclusive framework to help to facilitate that. The complexity and the global nature of the Pillar 2 rules and their newness, we have all discussed on many occasions. And there will inevitably be circumstances that have not yet been considered by the OECD inclusive framework in relation to guidance. Perhaps even the circumstances, have not yet happened, and therefore business has not yet had the opportunity to consider those circumstances either. And these will, because of that, lead to questions about how amounts in the future should be treated for the purposes of Pillar 2. As has already been discussed, consistency of approach amongst tax authorities will be necessary, and that means that these considerations will need to happen at the OECD inclusive framework level rather than in guidance from individual local countries. Further published guidance on areas as they arise will be extremely helpful, and that will be an important part of the rolling guidance that is proposed to continue to be produced. But it would also be helpful, and Will has already touched on this, if there were maintained ways of business being able to communicate some of these issues on as close to a real-time basis as possible to the inclusive framework to aid those discussions. This could perhaps be achieved by working groups within the inclusive framework set up specifically for this purpose, perhaps as part of the wider Forum on Tax Administration setup, or perhaps continuing the work of Working Party 11. This could perhaps draw on some of the best practices that the Forum on Tax Administration already adopts. For example, having multilateral meetings with many countries participating as possible, and also perhaps discussing anonymized Pillar 2 case studies to help to draw out some of the issues and then some of the proposed consistent response. The consistency of approach is clearly the key outcome. There's also a piece here around timing and whether this might be used to provide a quick route to resolve any potential differences before they become a dispute themselves. And obviously the outcomes of any such discussions in the meetings could then become part of future published guidance as the rolling guidance is updated. And the idea here is to help businesses and tax authorities move forward with Pillar 2 issues as they arise with some degree of pace. The problem here is perhaps volume combined with newness combined with the unknown. And that means that as soon as these issues can be dealt with, it would be helpful. Ultimately, of course, these kind of approaches are about dispute prevention. And they don't replace the need for there to be a tax certainty process or a process for resolving issues that have arisen, but they are additive in such a way that hopefully they would help to reduce the number of times that those certainty processes would need to be formally invoked. Thank you very much. I'm happy to take any questions if you have any.
Thank you very much, Alison. So yeah, I think here we can see some support also for other kinds of dispute prevention mechanisms with the involvement of taxpayers and the call for more transparency as well, which we thought were interesting. Thank you very much, Alison. Now with that, we know that we can't prevent all disputes from happening. And so there will be some cases where M&Es and tax administrations or tax administrations together will not agree or may have different views. So we may need a dispute resolution mechanism, and that's what the third panel will focus on. And so so the third panel is really on how we can resolve potential differences that would arise in the application of the GloBE rules. And the first panelist is Sébastien Desbouques, who is Vice President of Tax at Unilever. Sébastien, are you online? I see you have started screen sharing, so I guess you're here.
Yeah, thank you very much. And I hope my screen is indeed visible. So good morning, good afternoon. My name is Sébastien Desbouques and VP Tax with Unilever. And thanks very much for the OECD to give us the opportunity to share our comments on tax certainty, which is a very important topic to us. And in this one, I will focus on an MLC to ensure binding dispute resolution. But before doing so, let me briefly maybe speak about Unilever and what Pillar 2 is expected to mean for us. So Unilever, a global company in consumer goods industry, and we have about 100 jurisdictions where we expect Pillar 2 to be in scope, but based on current expectations, also a very small number of that only being subject to actual top-up tax. And our group structure consists of a variety of structures, so mostly fully owned subsidiaries, but also a lot of examples of partially owned parent entities and joint ventures. We furthermore expect, of course, our ultimate parent entity jurisdiction to implement a Pillar 2 compliant regime, IR, and we also expect various jurisdictions to implement domestic minimum top-up taxes. So I think that will sort of picture the scale of potential complexity, and with that also the scale of potential disputes to arise. So hence tax certainty is a real key theme for us. And as discussed in the prior panels, it's about correct and consistent application, of course, but it's also about tax advance certainty. However, since disputes cannot be fully ruled out, we also think there needs to be some form of a binding resolution mechanism, which would not only cover double taxation issues, but should equally focus on differences in implementation, interpretation, and application. And therefore, we believe that an MLC could be a very good instrument to manage this. And an MLC should be accessible, it should be effective, it should be broad in scope, not just for double taxation, but equally for interpretation and application. And I think an MLC would require a MAP provision, which could be based on Article 25 of the OECD Model Tax Convention, but also to include a form of binding arbitration. And the reason we think an MLC is required, as there can be Pillar 2 issues, which probably will not be solved by existing bilateral tax treaty provisions. So therefore, I think it should be recognized that some form of a multilateral instrument to solve bilateral or multilateral disputes is required for Pillar 2. What we also think is that there's an important role maybe in the MLC for the resolution of differences in interpretation and application. So for instance, it should be ensured that guidance and commentary as issued by the OECD, an example is the recent administrative guidance, is actually accepted by countries, and to avoid disputes would arise as to whether such documents are even applicable in the context of applying Pillar 2. And then to summarize maybe on some of the key characteristics that we think an MLC could include to provide effective binding dispute resolution is on the slide here, but a couple of them maybe to call out. So the taxpayer, in our view, should be able to actually submit such a request for a dispute to be resolved. And that could either be because there has already been an action, or there is an action that may lead to unintended taxation under the Pillar 2 rules. I think the MLC could also be used as an opportunity to confirm that any interpretation issues and disputes will be resolved in line with the rules, guidance, and commentary as issued by the OECD. And I think this is fully in line with, I think, the common approach as originally intended by Pillar 2. And this is not just important for taxpayers, but equally for tax administrations. And this should really set a common basis for dispute resolution, knowing that there might be finesses in domestic legislation implementation. It should be broadly applicable. So not only covering double taxation, but basically anything of non-alignment where disputes could arise. So interpretation, but also application and over-taxation issues should be covered by an MLC. And mandatory binding arbitration, I think, would be helpful because it will bring focus and encourage timely resolution, which again is to the benefit to not only taxpayers, but also tax administrations. And I think in terms of managing such a complex instrument, design elements can potentially be taken from the tax certainty processes being discussed and reviewed for Pillar 1. So a couple of examples there could be a lead CA, which could potentially be the ultimate parent entity jurisdiction, if assuming it implemented Pillar 2, of course, taking a leading and coordinating role. And the resolution decision to be managed by a panel of CAs instead of all CAs, potentially with CAs then providing input in writing on position papers. And if possible, an active role for the taxpayer as opposed to the generally more passive role under existing bilateral mechanisms that are there today, so that the taxpayer can actually provide maybe also position papers and can provide insights into how facts accounting systems are actually operating as the party probably most familiar with it. And then a couple of other things to summarize and finish maybe. I think the learnings and outcomes of such an MLC can also be used for future refinements, so addition to rules, guidance, or commentary, and potentially be incorporated into the peer review processes. And then finally, I think an MLC, as we know from prior experiences, will probably take time to negotiate, sign, and ratify. So working on retroactive provisions to give retroactive effect is something to consider as well. And then to finish off, I think when structured well, we really believe this is not just in the interest of taxpayers, but equally for tax administrations, so that resources are focused and more efficiently used in a scale of change like Pillar 2. And with that, I think I conclude my short contribution for today. And thank you very much for giving the opportunity to speak here today.
Thank you very much, Sebastian, and thank you for outlining the benefits of an MLC and what a dispute resolution mechanism could look like in that context. So as you've seen in the public consultation document, the inclusive framework members have also stated that they will initiate work on the possible framework for developing a multilateral convention that could cover, among others, dispute resolution. But they have also stated that they will continue to explore the benefits of the other options that were outlined in the public consultation document. So that is my transition to the next topic on the agenda, where we have Guglielmo Maisto, who is professor at Università Cattolica del Sacro Cuore. Yes, thank you, Guglielmo. The floor is yours to talk about the reciprocal domestic provisions that could be introduced for dispute resolution purposes.
Thank you very much, Felicity, and thank you for giving me the opportunity to present also on behalf of the contributors to the February submission, Roberta Known, Adolfo Martini-Menez, and Daniel Gutmann, our, let's say, proposal for a dispute resolution mechanism, which, unlike the previous comment made, we believe should be available from the very start of the entire Pillar 2 implementation, unlike a model treaty, which would require a lengthy process before actual implementation. And we believe that a dispute resolution mechanism can be resolved through domestic legislation. So we have sympathy for a dispute resolution dialogue between countries made through domestic rules. What we say is that a model rule should be included on dispute resolution by all the countries which will be implementing the global rules. And such rules should reflect Article 25 of the Model Convention, subject to reciprocity. I have a dialogue. If you have a dialogue, that would be basically the concept of the domestic model rule on dispute resolution. It should be put in motion once all of the jurisdictions involved in the dispute have been taxpayers have been actually activated the request and should be implemented regardless of time limits. There is experience on mirror legislation whereby countries which can't have a treaty in place, territories which are not recognized as states and therefore cannot conclude treaties between themselves, they have achieved the result of a dispute resolution dialogue and avoidance of double taxation through domestic mirror legislation. So it's something which has been experienced already by countries in other situations. We also believe that this rule, this domestic mirror legislation, should land in an environment which is the globe mechanism, which should support the dispute resolution, and therefore we suggest to complement the dispute resolution mechanism with provisions in the model rules having to do with interpretation and also with the globe rules adjustments. And the first rule of interpretation would have to do with conflicts of interpretation, where the countries involved adopt precisely the same wording of the globe model rules, but have a different interpretation. And such a general rule of interpretation, which would apply across the globe rules, which we call a sui generis interpretative rule, would make a reference to the legislation being implemented in the light of the globe model rules. It would also make a reference to the architecture of the globe framework, namely the object and purpose of the globe framework, and finally would make a reference to a rule of interpretation which will be in accordance with Article 31 and 32 of the Vienna Convention. These model rules and the domestic rules which will be adopted are not treaties. We realize that, but we believe that their structure is such that the same rule of interpretation adopted for treaties would or could equally apply once we have this provision in place and help and contribute to the resolution of dispute and interpretation of globe rules. Then we also suggest to adopt a rule of interpretation related to conflict of transposition, which includes a situation where one jurisdiction is adopting precisely and literally the globe model rules, but another jurisdiction is departing from the globe model rules. And there we suggest to adopt a rule which we call lex specialis, whereby in the event of a divergence between the legislation of one country and the legislation of the other country, the legislation adopting the model rules will prevail to the extent that is necessary to avoid double taxation. And once the setting of the rules of interpretation, either on conflict of interpretation or conflict of transposition, is set, and the domestic mirror legislation can apply to the dispute, and once the dispute has been resolved, then we suggest to basically have also a provision which permits to include in the list of the adjustments to the globe income and loss also an adjustment relating to the dispute resolution upward or downward adjustment. And so we suggest to have a specific provision addressed in Article 3 of the model rules and also in Article 10 regarding the definition. And with that, I conclude here my presentation and our proposal. Thank you.
Thank you very much, Guillermo. That was really clear. And thank you also for making the distinction between the different types of issues that could arise when there are interpretative issues or more issues related to transposition that may require the implementing jurisdictions to depart from their own domestic legislation. So thank you. I found that interesting as well. And so with that, we turn to the third panelist for this third panel, who is Roberta Posa-Cid, who is partner at PwC. Roberta, are you here?
Yes, I'm here. Hi, hello everyone. Hi, Felicity. So first of all, of course, thank you for inviting PwC to participate in this public consultation. So as we have heard, preventing disputes is not always possible, and probably the last opportunity that we have to avoid a dispute is at the time of the audit. And joint audits could be a useful tool to avoid having a dispute. In this sense, the OECD has already done some useful work on this, and it's possible also to rely on the MAC, although it may need to be reinforced. But to make a joint audit an effective instrument, we need probably two conditions to be met. First, that a company, an MNE, should be able to require the incorporation of one tax administration in a joint audit already initiated by another tax administration. And second, tax administrations should reach common binding conclusions. If this is not the case, the chances for having a dispute may be reduced, but will not be avoided. And this will imply a waste of time and resources, both for the company and the tax administration, that after the audit, we have to solve pending issues probably through a MAP or another dispute resolution mechanism. But what if there is finally a dispute? Well, then the mechanism we usually have is the MAP. It has already been said a lot about the opportunities to use a MAP. The applicability of the MAP will probably, first of all, depend on the nature of the disputes. And here, as it has already been mentioned, we have to distinguish those cases that are differences in domestic law, that it is probably more complicated to use a MAP here, although there is this option that Guillermo mentioned, or the cases that the dispute comes because of a different interpretation or application of the rule. That is usually where maps are used for. In this case, what do we need? Well, we need two requirements to use a map. First, that there is a legal instrument, and second, that there is a common standard. The common standard, I think we have it, should be the model rules, the commentary, the examples, and the implementation guidance, and the legal instrument should refer to it. But then we need the legal instrument. It has already been said that it's not easy to achieve the best probably legal instrument, that it's a multilateral convention. So because of this, we probably need to consider and promote all possible legal instruments. And in this sense, bilateral DTAs or maps that are regulated in already enforced bilateral DTAs can be used. For this, we need, as it was mentioned, to have this second sentence of the third paragraph of Article 25, that contracting states may consult each other on the elimination of double taxation in cases not provided for by the convention. But we probably need to reinforce the possibility of using this instrument. How can we reinforce it? Well, here, intergovernmental agreements could be a useful tool. They are easier to implement because it is not a treaty and it doesn't have to be ratified by the parliament. And it could be useful tool to interpret that, to introduce first the possibility of the taxpayer to request the initiation of the map, to state that competent authorities are endeavored to solve the case, not only to consult, and to introduce a procedure. To introduce a procedure that is a strict procedure that allows to achieve effective and efficient resolution of disputes in all cases. And if possible, this procedure should follow or should have those requirements that Sebastian mentioned, avoid that the procedure takes too long, establish arbitration to reach a solution on the case, and at the beginning of it, avoid cases not being initiated because there is a disagreement between competent authorities. Finally, two last points. Exchange of information provisions and the rest of the MAC can be a useful tool, at least at the first stage, to prepare for these cases, to exchange information and to agree on the facts. And it would probably be useful that the peer review process also analyzes the dispute prevention and dispute resolution mechanism. So thank you very much for this, and we're happy to continue working with you on this. Thank you.
Thank you also, Roberta. And so I take this opportunity to thank actually all the panelists for this first session on tax certainty. Thank you very much for sharing your thoughts with us and for taking the time to outline them to everyone. John Peterson will moderate the second session, that is on the global information return more specifically. Before we turn to that session, we will have a short break of 15 minutes, so we can come back here at 2:15 p.m. Paris time. And after his session, Marco Juvinale will also wrap up the whole session, so for tax certainty and global information return. So those who are interested in tax certainty are also encouraged to stay for the second half of this day to listen to Marco. With that, so I suggest that we take the break now, and we'll see you back at 2:15 p.m.
Insomma, rimane ancora, abbiamo un quarto d'ora di pausa. Ok.
Oh, hey. Did you decline mine or did I decline yours? I don't even
Okay, so I would like to welcome you all back to the second part of this public consultation session, where we are going to move from a discussion of the tax certainty elements on to discussion around the Globe information return. And I think it's important to emphasize, as Arkham did at the outset, that the document, of course, that we released as part of the public consultation, where we were seeking input, was not a draft return. It was rather an initial output that was designed to take the content of the model rules effectively and convert them into a sort of set of data points organized in a schematic fashion, precisely for the purpose of collecting public input on the types of data points that would be relevant and should be included in a Globe information return. So what you have, and we asked you to comment on, is not a draft return in any sense, but rather a starting point for a discussion on what this return needs to look like. And we did get very good and useful feedback as part of the public consultation on that initial document, and very strong feedback, notable in the 85 submissions that we received. Almost all of them called for a limiting of the reporting requirements under Globe, on the basis that, you know, firms said, look, that in many cases the data is just simply not available in the context of our existing accounting systems. It does not exist and would have to be created specifically for Globe purposes, or if it does exist, it cannot be accessed at any reasonable cost. Also, questions were raised in the context of public consultation around whether tax administrations really needed all these data points in order to do the types of risk assessment and verification that was required. And this was really coupled with concerns around data sensitivity and whether that information was going to be made broadly available to all participating or implementing jurisdictions. In terms of then addressing some of those concerns, then in terms of the public comments that were made, there were a number of calls for this information to be provided not on an entity by entity basis, but on a jurisdictional basis, and as well as simplifications, call for specific simplifications that could be made to the return to eliminate or reduce the number of data points that were required. There was also calls for a segmented approach in relation to the filing and information exchange mechanism that would limit the information that was provided to a tax administration to those jurisdictions that really needed it to verify the underlying calculations that are required under the rules. There were also calls to streamline the reporting requirements in line with or together with the current reporting under CBCR, because of the similarity in some of the points that are being collected there. So calls for us to not impose two sets of compliance and reporting obligations under different sets of rules that require slightly different sets of data. And suggestions were made that, you know, given the systems and compliance issues are most likely to be prevalent in the initial years in which these rules are introduced, much like we heard in the tax certainty context, there were calls for, you know, transitional mechanisms that could be applied in the initial years, beyond those, of course, that are already provided for in relation to the transitional safe harbor. And more broadly, commentators also called for extension of the existing safe harbors and called for new safe harbors that would reduce compliance burdens in relation to the return, because clearly if you qualify for a safe harbor under these rules, you have a smaller amount of compliance to do in relation to the collection of the relevant data points. So in light of those general comments, what I wanted to do was to call on the panelists that we have here today to discuss certain aspects of that. The first is Mika Van Gorp, who's a senior transfer pricing specialist at the ZF Group. And Mika's, we've asked Mika to speak directly to this question of whether the information that is reported under the return should be aggregated at the jurisdictional level. So over to you, Mika.
Thanks, John, and thanks a lot for having me here today. Really appreciate being part of the process today and in the past. So when considering the Globe information proposal from a data collection perspective, it's important to understand that M&Es don't have a magic data button that spits out information in any format and level of breakdown on demand. Each new data point that doesn't already exist requires a setup of a new process to collect that data, reported in the required format and collated at a central source for filing preparation. Each additional data point collected is associated with an additional incremental cost to M&Es. To this end, there are two key concerns in relation to the level of data that was covered in the proposed Globe information return format communicated. Firstly, the current proposal that the Globe information return be provided on a constituent entity by constituent entity basis. This has already been mentioned a number of times today. The organizational and financial reporting systems of M&Es will always reflect the unique features of its operations and the industry in which it operates. Each M&E will therefore have different reporting frameworks and experience its own unique challenges in performing those Globe calculations. The constituent entity or legal entity concept as such is often not critical from a business operations perspective, and many financial systems therefore don't reflect this level of reporting, at least at a primary level. Though it is understood that based on Globe rules that the Globe calculations are required on an aggregated constituent entity by constituent entity basis for a jurisdiction, the requirement to disclose on this basis limits M&Es from applying a flexible approach to implementing the Globe calculation process with their existing financial reporting framework. For example, various data points may be available at a jurisdiction level, as this is already necessary for existing financial and tax reporting requirements, for example. They're therefore allocable to a jurisdiction, but not necessarily constituent entity level. The amount allocable to the jurisdiction doesn't alter the calculation outcome, whether the data is aggregated on a jurisdictional basis or allocated across constituent entities based on some allocation key. Disclosure at constituent entity level therefore restricts the ability of M&Es to simplify internal data collection processes and would require additional implementation efforts and therefore associated compliance costs. The second concern is the aspect of the proposed Globe information return disclosure requirements associated with the separate disclosure of additions and reductions for adjustment items in the calculation. Many of the data items are taken from accounts, where possible our central consolidation system to ensure all data is consistent. The approach also allows automation of data collection, thereby allowing M&Es to manage compliance costs. An M&E's financial reporting system is often not interconnected. There's no central functionality that can access all global data, no capacity to neatly drill down to the granular transaction level. For companies, especially that have grown organically over decades or even centuries sometimes, the system landscape is usually made up of hundreds of different ERP systems, each with a different unique chart of accounts. The consolidation system maps those accounts and takes the end balance of each account to create the amount shown centrally, not at an individual transaction item level. This means that, in a nutshell, many M&Es can't calculate the additions and reductions in those cases where accounts used swing both ways, essentially. Aggregation of data at jurisdictional level rather than at constituent entity level and on a net basis better reflects the existing financial and tax reporting requirements globally. And to be clear, the aggregation of data at a higher level doesn't mean the calculation process isn't being done correctly. Indeed, the data and processes associated with generating that data at all levels are subject to rigorous audit procedures. It's the data availability, the effort associated with collating that data at that level and automating this data collection process, which creates significant compliance burden and is causing concern amongst the business community. This means essentially that the aggregation of data doesn't compromise the integrity of the Pillar 2 policy framework and doesn't change the Globe calculation outcomes. A jurisdictional and net level reporting does, however, balance the compliance burden for M&Es, whilst also providing tax administrations with an appropriate level of information to allow a tax risk assessment, which is generally the purpose of tax filings and which they're used to today already. I'll hand back to you, John, but thank you. We're keen to continue supporting the development of the proposed reporting requirements to continue to a solution that supports both M&Es and tax administrations. Thank you.
Thank you, Mika. And I think some pretty clear messages in a number of the submissions around the fact that M&Es have very different types of reporting frameworks, accounting and reporting frameworks, no two systems alike, and indeed the need for us to provide the appropriate level of flexibility given the broad range of M&Es that are being brought within the scope of these rules. And I think the points on how there's a central functionality associated with the consolidation system, but very different ERP reporting systems underneath does bring out the point about the ability to access the data at that granular level for doing the line item adjustments. So I think those were two clear messages that were received out of the public consultation. And as Will Morris was sort of indicating, I think the sort of next steps in that discussion are to understand how those different approaches that might be adopted to data collection and reflection on the globe return can be done while still sort of preserving the overall integrity of the outcomes, taking into account your statement that there's no difference in the data numbers, just in the way in which they are being recorded and presented. So very helpful. Thank you. Perhaps I can now turn to Lika Mutsas and Grant Wildell Johnson, both who are at KPMG, who have in their submission talked about the need for some kind of transitional relief in relation to the application of the globe return requirements, particularly in those initial phases when the systems and compliance issues are perhaps the most challenging.
Perfect. Thank you so much, John, and happy to be here. And thank you for the opportunity to share some of the suggestions we included in our submission. I think what we see is two ways of simplification, whereby we look into categorizing in respect of requiring less precision in the calculation of the globe tax liability, and simplifications in light of reducing the information to be included in the globe information return in the year. Let's look at that first category, requiring less precision in the calculation of the globe tax liability, where we see that allowing M&Es the flexibility to adopt a more conservative number rather than a precise number in their calculations will help reduce the complexity, reduce their compliance burden. For example, looking at the substance-based income exclusion, it would of course be in the benefit of the taxpayer to support a high amount of substance-based income exclusion. But this can also come with a cost if an M&E is required to also extend, for example, the payroll costs to certain contractors, and the need then to assess which contractors are in or out of scope. If M&Es are allowed the flexibility to adopt a more conservative approach, in this case, a lower amount of payroll costs, this could greatly reduce their compliance burden. Well, another way of reducing that compliance burden is in the way, as mentioned, the second category, in the information which needs to be included in the globe information return. So let me share a slide where we outline the four categories we were considering in this respect. Let's see whether that properly works for you. Perfect. So let me address those first two, transitional simplifications and the revenue exclusion. Well, the first one, that's transitional in basis, where we consider applying a layered approach in providing the data in the globe information return. So meaning that in the early years of the globe rules being applicable, for example, covering the first fiscal years in line with the transitional CBCR safe harbor, you would build up on the data required as part of globe information return. High level of simplification can then be applied in the early years, with additional information being layered on in subsequent years, allowing M&Es to put systems in place to collect the required data over time where possible. Second simplification considers revenue in a jurisdiction by either utilizing a percentage of total revenue or a specific amount, which can be indexed each year. And the workings are in both cases the same. If revenue of jurisdiction falls below a percentage of total revenue or below a specific amount, detailed calculations would not be required to be disclosed in the Globe information return for that jurisdiction, which of course does not mean that the calculations are not made as part of supporting work papers, but they're just not disclosed in the Globe information return. And with that, I think, Grant, you would be picking up the other two we're
And I hope you
showing.
don't find that slide daunting. Going back to what Sebastian said earlier in relation to tax certainty, he had a group with 100 odd entities, but only a few of them had top-up tax. And what this is trying to do is bring a degree of focus in relation to information that needs to be gained based on the level of headroom, if you like, between when top-up tax will kick in and what is the prima facie, I suppose, effective tax rate in that particular jurisdiction. So an example might be if you've got excluded dividends. We know that there's a carve out in relation to short-term portfolio shareholdings, and that would require someone to go through and work out what the 12, whether the 12-month holding period was satisfied in relation to that once they had discerned the level of interest being 10% or below. Do we need to do that work? A CFO or a CTO says, no, I've got so much headroom in relation to this before I pay top-up tax in this particular jurisdiction. I don't want to do this. So this is to try and address that situation. So you've got PBT from the qualified CBCR, and you've got prima facie or aggregate ITE from the qualified financial statements, and then you're making adjustments as you do for the transitional safe harbor, in addition to taking out items where it's not reasonable to assume it's below a single item threshold. And I know that's iterative, but you can work through that. And here we've got an 1800 or 18% ETR at 15%. We've got a headroom, prima facie headroom of $300,000. Now you apply a materiality factor to that under this methodology, and I've picked a very low number of 2.5% in relation to that, which is 7,500. So that's 7,500 tax affected, or 50,000 grossed up in terms of an income and expense line. So that's a single item threshold for that jurisdiction, by which, if you can say it's reasonable to assume that a particular position is there, then let's do that. Let's not do the work in relation to the 12-month holding period. But you might say, well, you need an integrity check on that because you can't have that for many jurisdictions, many items. So you look at the headroom. What I've done there is taken that 300,000 headroom, I've grossed it up to 2 million. I've taken the single item threshold of 50,000. That's 40 items in which you could say an item is reasonable to assume to be below a threshold such that it won't make a difference to the ETR. That's a fundamental methodology that could be played with either for guidance or as a firm rule, whereby a CTO or CFO can direct someone in a jurisdiction, okay, we'll ignore short-term portfolio dividends or don't do the work in relation to holding periods if you expect that the income from that is going to be less than a certain point. So I just thought I'd raise that. Good minds around the room could play with that and end up with a sort of better results. The 2.5% materiality threshold was deliberately chosen as fairly low, and the 40 is probably very high, but you can play with that. One can play with those numbers for a better outcome. So thanks, John, for the opportunity to speak here.
No, and thank you both for your submission and for the presentation, which I thought was very clear, actually, notwithstanding, as you say, the number of line items on your slide, and I think it does bring out, the essentially going back, I think, to Alan's point about the shift towards self-assessment and risk-based assessment. Which really informs much of our corporate tax compliance in this space. I think what you have suggested here does have the merit of sort of being a sort of a pragmatic representation of that style of approach, and is certainly the type of thing that we need to be thinking about in the context of some of these simplification style methodologies. So thank you very much for that. If I could now turn to Axel Rüttler, who is the head of tax in Germany for Siemens. And Alex is going to talk to us about the need for further reporting simplifications, focusing on reporting of changes to the corporate structure, for example, that occurred during the reporting year, and other items where perhaps there are further opportunities for us to think about simplifying the disclosures that are required. Axel, sorry.
Thank you, John. Thank you, John, for the invitation, the kind introduction, and the possibility to present two selected simplifications the Siemens tax team came up with, and looking at some of the other letters that have been published. Siemens is not alone with those proposals, so I hope many of you will find yourself in those proposals again. However, the two selected examples here do not solve the overarching concern which we generally have with too much information, too detailed information, constituent entity level information, but these two examples are proof points where indeed too much information, in our view, could even be confusing and in the end lead to more questions than answers. One of them is the treatment of tax consolidation groups. Now, let's all imagine the situation where there is top-up tax arising in a specific jurisdiction. Let's say there's a dozen legal entities in that jurisdiction, but all of those legal entities are part of one single tax group in that jurisdiction. And you all know the legal entities transfer their tax base to the controlling entity, and only the parent entity of that tax group in the end pays profit tax. Now, in such a constellation, does it really make sense to report constituent entity level information? I understand this comes from a rather legal entity approach perspective, but tax groups are more like IFRS groups. They are economic structures, and therefore we pledge, for example, in this case, for the option to report tax groups aggregated in one line only, and of course limited to the profit line without the need to actually open up the entire calculation. The other example relates to the changes in the corporate structure that occurred during the reporting fiscal year. Now, in large multinational groups, there are a significant amount of changes, and we believe that most of those corporate structure changes have no effect on taxes at all. And there's also no tax strategy behind it. It has very different business reasons. And especially in countries where the ultimate parent entity sits in a jurisdiction which has a qualifying income inclusion rule, we see no risk that tax structures are hid or are the background to those changes. Indications for changes that have no effect on taxes are, for example, multiple changes in 1 year, purely group internal changes with no effect on the consolidation method under IFRS. It often relates to the integration after an acquisition. That's the last step. The economic integration is performed, and then the legal integration is the last step after the acquisition. Or it is in preparation of carving out a business unit where all of those changes have to be performed, and it has absolutely nothing to do with taxes and not even effects on taxes. And even in the model rules, we find regulations that this has no effect on the global income. These are excluded gains and losses in certain cases if you look at the model rules. So what is the intention to report each and every change during the year if it could already be sufficient to take a look at the year end compared to the previous global tax declaration and see what changes have occurred by comparing two of those global information returns. We believe it would be quite sufficient to limit the reporting to year end. And with this, those two examples.
And thank you, though. Those are, I think, very useful in terms of just getting people to focus on some of the requirements that are in the return, and then but thinking a little more deeply about what the implications are going to be for some of these larger corporate groups, as you say, where there's tax consolidation mechanisms that are either in place which de-emphasize in one sense the importance of the precise nature of the tax calculation on an entity by entity basis, because in fact that's not how the underlying tax is being done, and the point on corporate structure is well made. And I guess this is another issue that we have been thinking about. I think we do need to sort of be cognizant a little bit of the rules we have around minority interests when we get to the allocation of top-up taxes potentially in situations. But in a situation where the group is in practice outside of the global rules because they have effective tax rates that are above the minimum rate, then I think we can see that there could be significant amounts of work there without any impact on the overall compliance picture. So thank you very much for those submissions, Axel. They have been very useful. Finally, perhaps I can turn to Jonathan Culver. Jonathan is a tax partner at Deloitte, and he's here representing the Capital Markets Tax Committee of Asia. Jonathan had a submission that touched on a number of points. We had asked him to speak to the questions in relation to country by country reporting and the potential streamlining. We may have observations on other comments that are made by speakers as well, Jonathan. So I pass over to you.
Perfect. Thank you, John. And before I get started, let me thank you for the opportunity to speak, but also apologize to you for the pattern on my sweater. I am on vacation at the moment. Unfortunately, my wardrobe options are somewhat limited, so sorry to everyone's eyes for that. In terms of what I plan to cover today, two discrete points really. The first is on what is really going to be a proliferation of relevant CBCR data across the various possible safe harbors, and the need to make sure that that is as aligned as possible in order to create simplification and to minimize the compliance burden it creates. The next point is really around the need to create simplification of filing and arguably to amalgamate the filing of CBCR data with the GIR. Now, if we start with the CBCR discussion, of course, as of today, there is a CBCR filing requirement. Most M&E groups should be familiar with this requirement. It's been in place for some period of time. The data sets required for it are well known. Of course, with the introduction of the simplified ETR, we have a situation where there are new requirements in respect of that CBCR data. So in fact, when we look at the numerator, we're entirely replacing the numerator with covered taxes with uncertain tax positions removed. That seems quite simple in the context of quite complicated global rules, but also it's not perhaps as simple as it seems, because of course, when we look at the full global rules, we look at adjusted covered taxes, which is the definition of covered taxes plus further adjustments. So taking just the covered taxes definition by itself with an adjustment to it is taking perhaps the global rules in a way they weren't originally anticipated to use. So it's a complexity. If we then look at the denominator, we have the CBCR rules, but we have an adjustment to them. So for example, one adjustment which seems simple, the removal of or the adding back of losses in excess of 50 million euros that are unrealized. That seems entirely straightforward and simple until you put it in the context of a large banking group or insurance group that doesn't have accounting systems that differentiate between realized and unrealized amounts, and have huge portfolios of things like bonds, right? So we have a carve out for short-term portfolio holdings, but of course there's also other assets. So we have these, we have a safe harbor which is designed to be more robust and those design considerations, absolutely make sense. But we also then have two sets of quite complicated data, both based off CBCR. And then, of course, we have the potential for a permanent safe harbor with a simplified ETR concept, perhaps in that. And that could, again, be slightly different to what's conceived in the CBCR rules themselves and the transitional safe harbor rules. So we have the potential to have three different sets of kind of CBCR-based information with varying complexities, which could cause quite a headache to MNE groups. Now, of course, the overall intention here is to simplify compliance. And so, therefore, it would seem to make a lot of sense to seek to align these requirements as much as possible. Take a step back now and try to get this right so that groups only have to adjust their accounting systems one time and only have to create processes to capture this information one time. Now, the importance of that can be perhaps illustrated in a fairly simple example. If we have a situation where, for example, a group files its CBCR return based on current rules, they file, let's say, 1 year after their accounting year end, and then say 15 months or 18 months after their accounting year end, they also file their GIR with their safe harbor election or their safe harbor information as well. A tax authority could look at the CBCR and find that it arrives at a different answer to the safe harbor position, right? And so they could then say, well, we'll seek to try and reconcile these, or this MNE group may be on the cusp, maybe on the edge. So why don't we try to launch an audit and figure out what the difference is? And maybe they'll be in the full globe rules, and maybe there'll be some additional tax to collect. So there should be one source of truth for a lot of these things. And this should, create a lot of, well, hopefully this will create simplicity for MNE groups and tax authorities alike. Now, if you believe then that we should have alignment of the data, perhaps we should also have simplification of data. So perhaps certain aspects of CBCR rules that exist today could be removed. For example, the need to report cash taxes, using slightly more robust covered taxes definition with uncertain tax positions removed might facilitate some simplification around CBCR. But once you have that simplification, then you think, well, how about streamlining administrative requirements, right? So these rules, they will look towards consolidated financial statement information, right? It makes sense for an MNE group to run the processes around that one time, and therefore it makes some sense to really just amalgamate the CBCR reporting together with the GIR, right? These are very similar sets of information, so the GIR could effectively have a section of it committed to CBCR data. That would seem to make sense to remove duplicative filings of roughly the same information. It would also help, MNE groups from a process perspective, but I think importantly would also help tax authorities with the usefulness of the information, and hopefully it would help them to make more sense of it, because of course many authorities around the world themselves are struggling for resources at the moment. So with that, I'll close and thank you again for the opportunity to provide comments.
Thank you very much, Jonathan. A very thoughtful submission. I think certainly we can certainly all see on the Secretariat and the Working Party side that there is a discussion that needs to be had about the relationship between CBCR and the global rules and the filing requirements. That's certainly a conversation that has to be had. Some challenges there, obviously, in terms of the fact that, of course, CBCR was designed for a different purpose. It has a slightly different set of a network for the information exchange, and so there are some sort of underlying design issues that we would also need to think about as part of the process. But I think the points that you make are well made and certainly well understood. So thank you for that. Look, if I can now turn to the second half of the discussion, moving perhaps beyond the content of the global information return itself and its interaction with other information reporting requirements, to an exploration of the significant compliance gains that may be available from coordination and administration of those filing requirements. And it's already, many of the submissions noted, of course, that the Globe return does already provide a mechanism for a single point of filing. So in that sense, there's already a clear simplification in terms of the administration and compliance of these rules built into the infrastructure of the Globe rules themselves, the model rules themselves. However, there were a number of submissions that said, look, these compliance concerns could be further addressed through further administrative coordination. Coordination as to the timing of the filing, and any corrections, any payments that are made in relation to the returns, as well as looking at things like follow-up requests for information, coordinated risk assessment, audit. Could all be coordinated at an administrative level to improve the overall gains associated with having a consistent and coordinated set of rules. And there were other submitters that noted, of course, that the QDMTT, the qualified domestic minimum top-up tax, needs to be folded into this framework, because currently there really isn't a story about how the QDMTT sits together with some of these other filing requirements. So we're very fortunate that we have been able to reach out today to a number of panelists who are prepared to talk to us about these types of issues. I want to start with Tanya Saulnier. Tanya is a Deputy Tax Director for Tax Affairs at MEDEF, and she was going to speak, I think, to this single one-stop shop filing arrangement that we have in relation to the Globe rules themselves. So Tanya, over to you.
Thank you, John. I think you can all, I hope you can all hear me well. So I'm Tanya Saulnier from the Mouvement des Entreprises de France, the French largest business organization. Thank you very much for this opportunity to present our views. And on this panel, I'd like to maybe detail a little bit more some of the solutions that we see useful for our business and to address concerns. So from the business perspective, there is really a need for proportionate and balanced requirements. I think that's our key message. And an initial observation I would like to make, I don't hear this very often, so I would like to say this. There are a number of mid-caps that will be included in the scope of Pillar 2, and mid-caps, they do not have the resources of large M&E groups. So we need to take their situation into consideration. They have very scarce resources and ability to tackle such complicated rules. So one aspect of proportionate and balanced reporting requirements would be for us to have a central filing obligation. So something that works like CRS and CBCR, which is followed by an exchange of information, which is treaty-based. And so why are we asking for this central filing obligation? Well, we want to avoid a fragmentation of the reporting requirements, of the timelines, and we want to avoid domestic variations, basically, because even small variations in domestic requirements, that can entail significant costs at the end of the day for M&E groups where you have hundreds of jurisdictions when you cover. We also want to limit disputes and situations where you have to deal with refund of top-up tax liability. So for instance, where you have a jurisdiction that would require to report and maybe prepay top-up tax even before the Globe information return is filed by the UP, that is not a desirable situation. What we want to avoid is to have an ongoing refiling process. That is something that is not compatible with legal certainty, where you have the reporting requirements open for too many years. So our main idea is say it only once and say it centrally, basically to have a neat, simple situation. Another very important aspect is that central filing will also address the major concerns we have in the field of confidentiality and the risk of data leakage, and also the risk of misuse of information. Where you have an exchange of information, a state-to-state process, this for us plays as a guarantee, because there is sort of peer pressure, right? Because if one jurisdiction does not meet certain confidentiality or appropriate use conditions, then exchange can be suspended. So, I mean, that is a guarantee for the taxpayer. We are in a world where cyber attacks on administrations is become a common situation. So we want to make sure that countries will apply the highest standards in terms of security, securing data, and also the highest standards in terms of appropriate use, only using the information for Pillar 2 purposes and not for anything else. Local filing, that is something that will introduce administrative burden. For us, it's a disproportionate requirement to have requirements locally. That might be a nightmare for M&A groups to follow. And we continue to question whether this is compatible, by the way, with the Action 13 minimum standard. And again, for us, it does not give us a sufficient level of confidence as to the confidentiality and appropriate use conditions. So a last thing, maybe in practically speaking, how could you allow this exchange of information? Well, I think a lot of work has been done in the CBC and CRS space, also maybe on spontaneous exchange. So there are probably avenues to make this work. On central filing, I will just add a few words on segmentation and QDMTT that Belinda and Anne will explain more in detail. Segmentation, this is absolutely key for us for confidentiality, and Belinda will explain this. The Globe Information Return could work with modules, and this is very compatible, I would say, with central filing. If you have a segmentation, there must be one tax administration sort of overviewing how segmentation will work. So in our view, the UP administration is the best placed to do that. QDMTT, just a few words. It's a game changer. I would like to emphasize on this. Really a game changer. It entails finally a fragmentation. It is a decentralization of the top-up tax liability, and it might entail a decentralization of the reporting requirements. And that is something that worries us, in addition to the fact that maybe CBCR or safe harbors may also not apply, which we hope not. So we'd like to explore how maybe there could be an option for MNEs to file centrally and also to apply maybe the accounting standards of the UP. The idea is always for the MNE to have the option to apply what is centrally done. So that was it for the central filing. Just a few last words now on the need for coordinated and streamlined timelines. I think we should explore the idea that there is a verification period, a sort of Pillar 2 verification period, where it is a given time frame which is open for tax administrations to question and request, to make requests. But what should be clear is that there should be a closing date, because you cannot be in an uncertain legal position for years and years. For instance, you could say, well, okay, when the exchange of information occurs, then you have 3 years to make requests or ask questions, but no longer. But that because you have to close this, and you have to have a clean situation, basically. So that would be our proposal, to have this verification period, and then there needs also to be a coordination of statute of limitations, because and this also, if you have a central filing, I think it helps the overall design. It helps not to have all these competing statute of limitations. An important point is where there needs to be a credit at the level of the UP or at the level of a POPI or whatever. They should not be blocked by the statute of limitation. So there needs to be coordination between the different rules of the different countries. So that is basically what I wanted to say. And of course, we in general call for much more simplification, but I think a lot of messages have been voiced. Thank you, John.
Thank you very much, Tanya. And of course, with the framework that we have in the existing rules, of course, does provide for local filing by default, but there is clearly a mechanism in there that contemplates precisely the type of thing that you have described, and indeed that is the active task of the working party, to ensure that we can deliver on that promise in one sense that is made inside the model rules. So that's certainly the outcome that we are focused on achieving. So thank you very much for that. If I can now turn to Belinda Chan. Belinda is head of tax at Temasek, and you will recall that when I opened the discussion here of the Global Information Return, I had noted that there were a number of submitters who were concerned about whether this information was necessary for a tax administration to have and necessary for all tax administrations to have. And Belinda has kindly offered to speak to us on that question and some of the business concerns around that. So I hand over to you, Belinda.
Thank you very much, John, for that introduction. Good afternoon and good evening. I would also like to thank the Secretariat for this opportunity to share my views. Just a quick introduction. Temasek is an investment company that's headquartered in Singapore. I have one slide. Let me pull it out. Okay, I hope everyone can see my screen.
Can, Belinda. Currently we see black, though. We don't see anything.
Oh, you can't see it. Okay, just let me try.
Actual slide.
Okay. It's kind of spinning. Just let me. Oh, can you see it now?
No, we can't. Still, we're seeing a blank.
Oh, we can't.
Yeah.
Stop. Let me stop sharing it.
Try resharing, I guess.
Yes, I'm going to stop sharing. Yeah. Arthur, just let me start.
Arthur can share it. He says he has it, so he's happy to share then. And so why don't we get Arthur to do it, and you can already start your presentation, Belinda. That's no problem at all.
All right. Okay, great. Thank you, Arthur. I hope people can.
Yes, I'm happy to share it. I just need to wait for you to stop sharing your screen.
Oh, yes, I'm trying to stop, but they seem to have sort of
I believe I may have it, and I think I can do it. So you'll tell me, Belinda, if this is the right one. I think that I can share. Does that show? Can you see that?
Yes.
Okay. Then I think for some reason we lost Belinda, but I think has she come back in?
Yes, I'm so sorry, John.
No, you're right. You're absolutely fine. Did I kick you out? I probably did.
Yes.
This is not my forte. I do not do IT very well. The team can testify.
No worries. Someone is trying to get rid of me.
It's not me. But I think I'm now screen sharing. It's what it says I am doing on my screen. So hopefully you can see that. And we are in business. Good news.
Okay, great. I hope everyone can see the one slide. Sorry. Okay, I was just saying, just a quick introduction. Temasek is an investment company headquartered in Singapore. We are appreciative of the IF and the OECD for being open to the need to segment information reported under the GLOBE or Global Anti-Base Erosion, Information Return, or the GIR for short. A standardized GIR form should not entail wholesale, undifferentiated sharing of thousands of pages of commercially sensitive data with each and every jurisdiction of a multinational enterprise our M&E has presence in. If we take section 2.2.1 on the corporate structure and substantially all of section 3 on the ETR computation and the top-up tax computation, many of the data points are commercially sensitive. They will show how profitable a particular location can be from the revenue and expenses numbers. These are important market information for competitors and potential competitors. With the analytical capabilities we are able to deploy today, including artificial intelligence, such information may be used for many other purposes other than text. The rationale for GLOBE is to ensure that M&Es pay a minimum tax and not to undermine businesses and companies. Further, not all jurisdictions may require detailed information down to the entity level for purposes of GLOBE. Our view is the full standardized GIR may be unnecessary for many jurisdictions, except perhaps for the—
Do you have any financial information in 2.2.1?
Except for the ultimate parent entity or the UPE jurisdiction. We support segmentation being the differentiated tiering of disclosure of GIR based on relevance and the need of each jurisdiction. Here are some of our proposals put forward for consideration. Firstly, to align the right to receive the GIR data with the right to levy top-up tax. Jurisdictions where an M&E is eligible for safe harbor rules, unless that is also an UPE jurisdiction, should not require the full GIR, but only so much information as is required to verify that safe harbor is indeed properly applied. In addition, a jurisdiction implementing the Qualified Domestic Minimum Top-Up Tax or QDMTT may only require information relating to resident entities and not the full GIR. Another example would be where there are partially owned parent entities or POPs, where only the downstream constituent entities information may be relevant and not the other parts of the M&E. Therefore, we will propose for the GIR to be segmented into modular parts, with jurisdictions receiving only need-to-know information. We could also institute an annual declaration mechanism by the UPE administration as to whether there is a change in the GLOBE status of the particular M&E, with the assumption there will be no change unless otherwise informed. Secondly, the GIR could also be segmented based on an aggregated jurisdictional level rather than entity by entity basis as proposed by Axel in the first panel. To also implement a de minimis thresholds to exempt disclosure, which should also cover dormant entities, as the purpose of GLOBE is to ensure M&Es pay a minimum tax and not to discourage the setting up of entities for future purposes. Our final proposition would be once an UPE jurisdiction has qualified GLOBE, say the QDMTT and perhaps the IRR or the income inclusion rule, no GIR should be exchanged by the UPE jurisdiction. The assumption being there would be no residual profits left for any other jurisdiction to tax. All would be soaked up by the QDMTT and the IRR. And once a GIR is submitted to the UPE jurisdiction, as advocated by Tanya earlier, any access to the GIR would be via an exchange of information or EOI agreement between the jurisdictions. Where no such EOI exists, the MNE should not be compelled to provide the GIR. That is, there should be no secondary mechanism in place. Further, as some in the audience may be aware, jurisdictions are looking to make public the country-by-country report. We would strongly advocate against such a measure for the GIR, especially by UPE jurisdictions, given the full return has many commercially sensitive information. Such disclosure may have material downstream implications for multinational enterprises. In conclusion, a safeguard to ensure countries abide by the segmentation rules, we could possibly consider a peer review process, which can be discussed later, but or something that the Secretariat, I believe, is also looking at. This would be quite helpful to ensure that countries abide by some of these segmentation rules. Thank you very much, and I'll hand over to John for the next segment. Thank you, John.
Thank you, Belinda. And look, I think it's clear how seriously you take some of these issues around the data sensitivity, and you've thought quite carefully about some of the restrictions that can be placed on the flow of information in order to protect that. And so that's it's very useful to have your input. I think certainly message received. Perhaps I can go now. I can stop sharing. And I can go to Joel Cooper, who's the Global International Tax and Transaction Services Controversy Leader at EY, who is going to touch on, I think, something which Belinda just referred to, which is looking at whether the consistency administration type requirements can be supported through the peer review process. So over to you, Joel.
Thanks, John, and on behalf of EY, thank you for the opportunity to share some thoughts on these important topics. Pillar 2 in its design and implementation and what will be, I guess, its future administration is unquestionably a significant effort for all stakeholders. And we've talked a bit today, various people, about successful implementation, which is a term, as I said, several people have mentioned, but I guess it might have different meanings to different stakeholders. One would hope that it doesn't, but it may well. But I think what is really, really clear is successful implementation doesn't just mean the design of the rules and making sure they're then implemented in the countries, but how they're actually administered and they are actually implemented at a day-to-day level in different jurisdictions. For the successful implementation of Pillar 2, it's imperative that there is consistency and conformity with respect to the information reporting and exchange procedures around the Globe Information Return. And as others have already mentioned and discussed, those requirements around that return must not be unnecessarily burdensome. Others have already mentioned the different simplification measures. We've talked about the necessity for central filing, etc. But I think what I'm trying to elaborate in this particular piece and the topic I've been asked to speak to is what's really important is how that is actually implemented. Piecemeal and disparate filing requirements is not in anyone's interests. It's important that as a global tax community and as we move forward with this, we reflect on the learnings from the rollout of country-by-country reporting. We're all very familiar with some of the teething issues that came through that process, and I won't go into the detail of them, but I think it highlights that even well-designed and well-intentioned rules with best efforts by many parties to seek alignment in their actual rollout, when the rubber hits the road, so to speak, things don't always work perfectly. And there remain today numerous examples of country filing requirements that are reported to be contrary to the original terms of reference and agreement. And this is highlighted by the recent 2022 country-by-country peer review report, the OECD, which indicates that I think it's around 1 in 5 countries have domestic law or guidance requirements that differ from the terms of reference. That's not a position we want to find ourselves in with respect to the Global Information Return, and it's something we must avoid. So as these rules are designed and we develop these rules and come to agreement on all of the things that have been discussed today, what's really important that in parallel to that, you develop a robust and expeditious peer review process with respect to the implementation of the filing requirements for the Global Return. This will be vital to ensuring that things are implemented in the way that they're intended through these, many discussions and processes that are happening. Such a review process, the peer review process, really needs to have meaningful consequences for jurisdictions. And if they have practices that don't conform to the rules and procedures that have been agreed in the inclusive framework, decisive action needs to be available and taken, I guess, to stop what is otherwise a potential precedential slippery slope in terms of the implementation of the rules. Some of the key areas of focus that peer review process should address would be that jurisdictions do properly implement the centralized filing approach, which has been discussed before, into their domestic law, and that they accept centralized filings and enter into qualifying competent authority agreements where possible. It should look at that jurisdictions do not request local filing in a situation where local filing is not required under the agreed rules, and that they don't attempt to obtain that information by requiring different filing or other requests for the same information in a situation where a local filing shouldn't be required. There shouldn't be any local language requirements or requests for translations associated with the GIR. There shouldn't be requirements for advanced notifications around locations of centralized filing and so forth that are inconsistent with what ends up being agreed in the inclusive framework. To the extent that segmentation is agreed, the topic that was just discussed, that should also be followed in the local jurisdictions and be part of the peer review process. It's important that for any segmentation to achieve its intended objective of reducing compliance and addressing the information concerns, that it is applied consistently by all jurisdictions. I think when it comes to safe harbors, again, where they're agreed in the inclusive framework, that countries don't require information that is inconsistent with those safe harbors where applicable. There should be, again, consistency around the XML schema, and the peer review process should also look at confidentiality obligations with respect to the return. It should also consider penalties as well, and that any agreement reached in the inclusive framework around the administration of penalties is fairly and transparently taken into account. Deadlines should be consistent with the agreed rules in the inclusive forum. And finally, a consideration as well, which has been mentioned, that linkages with the GIR and other areas such as QDMT, etc., require careful consideration to ensure consistency of reporting requirements. In summary, we must recognise that once the final agreed approach to the GIR and the information return has been agreed, that's really just the start of the journey for multinationals and tax administrations. And history has shown us, the reference I made to the CBCR, is that checks and balances are needed to ensure appropriate implementation. And so therefore we would encourage that a robust peer review process with consequences is put in place with respect to the GIR. Thanks, John.
Yeah, thanks very much, Joel. That was very thorough. And a couple of days ago, we kicked off our discussion around the design of the peer review process, and thought about how that needed to be designed. One of the challenges, of course, is that we do have a significant number of jurisdictions who are all looking to implement at the same time, and there is a challenge in making sure that the process remains robust while also delivering on the outcome which countries are looking for, which is not to have delays, unnecessary delays in that process. So there are a number of issues that think about, but you're raising this issue is very timely in the context of those discussions. Finally, I think I'm going to turn to Anne Gordon, who's Vice President of International Tax Policy at the National Foreign Trade Council, who will touch on what is one of the interesting issues, I think, many interesting issues, but certainly one of the ones that I've heard raised the most often, and we've seen it pop up a number of times in this public consultation, which is how do the requirements around the global information return, all those things that we've been discussing, how do they fold into the QDMTT and the design of that and how they should operate? So over to you, Anne.
John, thank you so much. And thank you to the OECD for inviting me to participate today on behalf of the National Foreign Trade Council. We're the premier business association advancing tax and trade policies that support access to the global marketplace. We represent over 100 member companies, which span the breadth of the global economy, including energy, products, capital goods, transportation, technology, healthcare products, e-commerce, and retailing. I welcome the ability to review the GIR and provide comments on streamlining the documentation and compliance rules, especially in regard to the QDMTT. Before I turn to the GIR, I would be remiss in not saying a word regarding the related issue of safe harbors. The transitional safe harbor has utility for both MNCs and tax administrations, allowing each to focus resources on jurisdictions in which top-up taxes may be due. Due to the utility of country-by-country reporting and the transitional safe harbor, we request it become permanent. Moreover, we recommend that a QDMT safe harbor be adopted. I also want to talk briefly on the number of data points, as others mentioned earlier today. The draft GR requires a number of data points, which are significantly more than needed for efficient tax administration. We respectfully suggest that the work papers, that the current iteration of the GR be used for internal company work papers instead of a tax return. Providing extraneous information, for example, regarding income taxes of each constituent entity in the group may cause a data overload for tax authorities unaccustomed to complex returns. A few of our member companies quantify these, which I think would be helpful. One member company calculated that C/CR reporting requires just under 1,000 data points, whereas the data points required in the GIR requires over 50,000, a 50-fold increase. Another member noted that they thought it would be closer to 200,000 data points for them, an even higher number if it was based on local GAAP instead of GAAP of the UPE. So I just wanted to highlight those points and note that they are important to our members as well. Now I will turn to the part of the GIR that I've actually been asked to discuss. So first, deference needs to be given to the ordering rules. First, QDMTT, IAR, and then UTR, in determining whether return filing is required in any jurisdiction and the scope of the return. For example, where QDMTT is applicable, and assuming a QDMT safe harbor is adopted, no return information with respect to the constituent entities in such QDMTT jurisdiction should be required to be provided to a parent or related jurisdiction with an IIR or UTPR, because no top-up tax with respect to the QDMTT jurisdiction will be due in those IIR or UTPR jurisdictions. Similarly, no return information with respect to constituent entities subject to a QIIR should be required in any UTPR jurisdiction, because no top-up tax with respect to the QIIR will be required. To the extent that filing information is required, it should simply be a short form indicating that the entities in a given jurisdiction are not subject to the IIR or UTPR in case of jurisdiction. Let's turn to some practical considerations for the GIR based on the ordering rules. First, the QDMTT should be a set of standard rules with no deviations for countries imposing the tax. The OECD should provide a master list of approved QDMTTs. A country applying its IIR or UTPR should not be able to evaluate whether a country imposed a qualifying regime. The OECD peer review process should be the final arbiter on such determination. The GIR return for QDMTT should simply be part of the annual filing of that country's corporate tax return. This will be the easiest way to simplify things. For GIR purposes, a short form noting that the multinational filed in country X, which employs a qualified QDMTT, should be acceptable for IR and UTPR purposes. If needed, each country could provide a Pillar 2 tax identification number that could appear on the one-line return, listing the name of country, a checkbox that a QDMTT return was filing, and if needed, that number. If an MMC operates in only country of the QDMTT, then no additional information should be needed or provided to the IIR or UTPR jurisdictions. The Pillar 2 identification number will be used to confirm a return was actually filed in a given year without disclosing sensitive taxpayer information. And since an MNC may have multiple entities in a jurisdiction, listing the taxpayer identification numbers for each of those entities may cause additional confusion. For the IR, we would say that each country should be required to request the same categories of information on the IR return to allow for ease of administration. In an ideal world, the forms would all be identical. However, we realize the practicalities of processing different returns in each jurisdiction may require slightly different forms. It also might streamline the process for the IR and UTPR were filed in the UPE's jurisdiction along with the QDMTT of MA with the relevant IR and UTPR information that can be shared by the UPE jurisdiction's tax administrator. Information on the IIR return should list that the QDMTT was filed in the applicable jurisdiction. For constituent entities and jurisdictions without a QDMTT, additional information should be provided to allow the IIR jurisdiction to determine whether an additional tax rate exists, i.e., is the rate below 15%. If so, relevant information at the jurisdiction level should be provided so the IIR jurisdiction can confirm the calculation of additional tax payable is correct. No entity by entity details are necessary or should be required. For instance, if there's an election made on equity compensation, only the data and calculations required under the election should be needed. No other information on the non-election basis should be required, simplifying the calculations and the return. On the UTPR, similar to the IAR, UTPR jurisdictions will receive information that the MMC filed QDMTTs and IRRs in applicable jurisdictions. The MNC would then file a return either with their administrator or all UTPR jurisdictions, certifying those filings and then providing revenue and ETR information that would allow the UTPR jurisdiction to calculate the additional tax, if any, with respect to the constituent entities in the jurisdictions not subject to QDMTTs or IARs. The UTPR filings would be identical in all UTPR jurisdictions. Neither the IIR and UTPR jurisdictions should be allowed to look through transactions. The information provided to the countries involved in the transaction must be accepted at face value. Of course, the countries involved in the transaction would be permitted to audit, as they do now. However, if every IIR and UTPR jurisdiction were permitted to audit every transaction on the underlying terms, the audit process for MNCs under the GIR would be never-ending. In sum, the goals of the GIR filing regime should be to provide IIR and UTPR jurisdictions with sufficient data to assess risk and request additional information where there is risk of error or non-compliance. Providing a cornucopia of financial data at each level of constituent entities, including data related to jurisdictions for which no top-up tax will be due as a result of the ordering rules, only complicates the inquiry, adds to the client compliance burden, and creates risk that sensitive data is not protected. We'd also ask that all building blocks of the GIR regime, the GIR, the QDMT, the de minimis exceptions, be in place by the end of 2023 to allow for companies to ensure that their filing systems can be updated appropriately. We would also ask that all inclusive framework members fully commit to implementing the GLOBE with no deviations from the agreed format, so that the compliance burden associated with this, which is already significant, is not further increased. NFTC appreciates the opportunity to provide these supplemental comments on the consultation documents. As discussed, we support a standardized GIR to minimize compliance burdens, allow for ease of administration while protecting taxpayer data, and ensuring that tax administrations receive only relevant information. We look forward to continuing the dialogue as additional guidance is provided and the GIR return is filed. Thank you so much.
Thank you very much, Anne. And I think, look, that concludes the presentations that we have. I think the only thing that I need to do is pass across now to Marco. Marco Juvenali is the chair of WP11, the working party, which has been responsible for the production of the model rules, the commentary, the administrative guidance, and is effectively sort of part of this is the working party that has set up this focus group together with members from the tax administrations and also information exchange experts to do the work on the GLOBE information return and look at some of these tax certainty measures. So it's Marco who's in charge, and therefore it's Marco, I think, who can provide us with a summary of where he sees this conversation and where the kind of things we need to think about next in the context of these ongoing discussions. Marco.
Yeah, thank you very much, John. And let me thank first the OECD Secretariat for organizing this event today, and thanks all the participants to this public consultation. I would like also to send a word thank to the contributors in the written comments and also, of course, to the panelists that present their views today. And let me summarize the key messages of the today discussion, and also, as John said, the outline of the next steps. In terms of today's discussion on tax certainty, I think the first panel outline in particular why the tax certainty is a key element of the successful implementation of the global rules. And speakers highlight in particular that the rule order, the tax allocation, the allocation mechanism, and the need for administrative guidance in relation to specific issues are very important for the tax certainty. In the second panel, we heard the emphasis on the prevention of dispute as a more effective instrument than provide mechanism to resolve the dispute in the interpretation and the application of the rules. And in this regard, a coordinated risk assessment process providing binding and timely certainty has been indicated as a desirable process. And the speaker also highlighted the advanced certainty mechanism could be developed through with the objective to guarantee a binding outcome for the multinational enterprises that was made, for example, to the APA-like mechanism. We also heard a strong call for multilateral cooperation among tax administration, and also the suggestion to work together, for example, on anonymized case studies. The third panel on tax certainty discussed how difference in the interpretation and the application that may arise could be resolved. And in general, a strong preference was expressed on a mandatory and binding dispute resolution mechanism, and was support also for a multilateral convention to that effect. At the same time, it was acknowledged that developing a multilateral convention, it's quite a time-consuming exercise, and in interim time, the jurisdiction could explore improvements to the existing tools, both in domestic law and treaty mechanism, in order to improve resolution of the possible global disputes. On the global information return, I think the first panel emphasized the need for simplification, reduction of data points to the extent possible, limitation of the volume of disclosure to be included in the global information return, and also exploring the streamlining of the reporting requirements. And also we heard a suggestion on possible transitional approach to ease the burden for M&E, at least in the first stage of the global implementation. In the second panel, we had about the importance of standardized administration of global information return to a kind of one-stop approach that could rely on central filing and coordinated follow-up requests. And also we heard suggestion on the importance of the segmentation of information in global information return, the importance as well on the peer review process. That's, as John mentioned, the Working Party 11 has started to engineer, and also panelists expressed views on how to articulate the reporting requirement in the case of the application of the qualified domestic minimum top-up tax. And put this in the global information return. That's what we heard today in terms of the next step, and also in line with the very useful input received in the public consultation. The inclusive framework will now undertake work on the global information return and the administrative framework to ensure the implementation of the implementation of the global rules to minimize the compliance burden for both MMEs and administration. And in particular, in terms of compliance, we will seek to develop a global information return that strikes the balance between the administrative burden for MNEs on one side and the information needs for the tax authorities on the other side, both on the global rules and the application of the QD entity where the QD entity applies. And also we will try to facilitate cooperation among tax administrations, including a framework for the exchange of information among tax administration. On tax certainty, we will continue to provide guidance on the identified issues that require common interpretation. As said, we have also initiated work on a peer review process in order to ensure a consistent implementation of the rules. And we also will explore a specific tax certainty mechanism that could prevent and possibly resolve also issue related to the different interpretation and application of the rules, including the development or the possible development of a multilateral convention. So we appreciate all the contribution, the engagement on those issues you have provided with today's public consultation, with your inputs, and the various working bodies, the framework, the Working Party 11, the Forum on Tax Administration will continue to engage with the Business Advisory Group under the following work. And we thank you once again for the engagement, for your attendance today, and also looking forward to working with you in the near future, moving to the implementation of the global corporate minimum tax. Thank you very much.
Thank you, Marco, and farewell to you all. Thanks for your attendance today and contribution.
Thank you.